Hello everyone. Consumption and capital expenditure are going to be the two pillars of India's growth story over the coming decade. The rising penetration of consumer lending is a crucial catalyst for consumption. Consumer lending in India has shown impressive growth in the past decade, largely driven by the affluent class, which we call it as India One. This represents the top 10% of the households and accounts for 70% of country's retail credit. However, consumer lending is still in its early stages of reaching the middle class, India 2, and the lower income category, India 3. To provide context, the retail credit to GDP ratio in most emerging markets ranges from 30% to 50%, while in developed markets, it ranges from 50% to 100%. Currently in India, retail credit to GDP is around 20%, an improvement from 10% a decade ago, but still well below global averages. As per capita income increases, we expect the retail credit to GDP ratio to reach 30% by the end of this decade, with a more even distribution of credit among the population. Capital expenditure is another critical driver of India's growth journey. After a period of consolidation, the capex cycle is set to pick up, and it will last for an extended period. Government spending is currently driving this cycle, but private sector capex is expected to follow suit with a lag. Initiatives like the National Infrastructure Pipeline and the Production-Linked Incentive Scheme, the PLI scheme, aimed at promoting domestic infrastructure and manufacturing, contribute to the upswing in capital expenditure. The PLI scheme alone has the potential to generate a cumulative capex of 4.4 trillion rupees and boost revenues of BSE 500 companies by 10% over the next 5 years. Policy initiatives like these also support emerging growth themes such as electric vehicles and electronics manufacturing. In summary, the consumption-driven growth model, supported by consumer lending and upswing in capital expenditure, indicates a positive trajectory for India's growth. Over time, we have observed a variation in returns across different market capitalizations and sectors in the long term. Additionally, the leadership within sectors has also been subject to change. Against this backdrop, the Flexicap Equity Mutual Fund category offers several advantages. Flexicap equity funds provide flexibility to invest across market capitalizations, including large cap, mid cap, and small cap stocks. This allows fund managers to adapt to changing market conditions and capitalize on opportunities throughout the market. Also, sector leadership in the stock market tends to rotate over time. Flexicap funds can invest in different sectors based on growth potential, valuations, and market trends. This dynamic allocation among sectors may assist to enhance returns and reduce concentration risk associated with specific sectors. Overall, the flexibility offered by this category helps to optimize returns while managing risk better in the ever-changing investment landscape. Key attributes of the 360 Flexicap Fund would be: number 1, unique SCDV framework. As a fund house, we use a unique secular, cyclical, defensive, and value traps framework. It enables us to capture ideas across different market segments such as quality, growth, and value. Our Flexicap Fund would also follow this SCDV framework. Number 2, strong bottom-up approach. We would follow a bottom-up approach to identify opportunities across large, mid, and small cap segments, and across various sectors based on in-depth fundamental research. Finally, technology-enabled investment process. We use a custom-built research management system that reflects our investment process well. The platform enables us to use multiple analytical tools to generate investment ideas and is core to the team's collaborative process. As a fund house, we follow a stock selection framework wherein we split the market into 4 quadrants: secular, cyclical, defensives, and value traps, based on track record of companies on 15% profit growth and 15% return on equity criteria. The secular quadrant forms a core part of the strategy. It comprises of companies which are consistently growing profits by more than 15% and delivering return on equity upwards of 15%. These are quality companies which have secular growth drivers in place. Examples would be private sector retail banks, retail-focused NBFCs, consumer discretionary, retail, insurance, and automobile. The exact opposite of this is the value trap quadrant. It has companies which have struggled to generate 15% ROE and 15% profit growth over a long period of time. Examples would be public sector banks, telecom, oil and gas, and utilities. We would always be underweight this quadrant. Then we have cyclicals and defensive quadrants. Cyclical quadrant has sectors which move with the economic cycle. Examples would be industrials, corporate banks, cement, metals, and infrastructure. ROEs tend to be lower, but these sectors witness strong growth in cycles. Defensive quadrant has companies with high ROEs but modest growth for long term. So sectors in this segment would be consumer staples, healthcare, and information technology. So we allocate weights between these two quadrants based on our view on the macro environment and the economy. So there are three buckets: core, which is secular; tactical bucket, which has cyclicals and defensives; and the least preferred bucket, which is the value trap. So that's our SCDV framework, which forms the basis of our strategy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.